Hi, good morning, everyone. Thank you all for joining us for this wonderful morning. I'm Saket Kumar, co-founder at ETF Junction. Let me share a brief what ETF Junction is all about. ETF Junction is basically a fintech platform which intends to provide a complete ecosystem uh, for the entire ETF industry in India, which involve manufacturer, ETF service provider like stock brokers, investment advisors, influencers, and all the end user called investors in India, the potential investors of ETF and passives. The endeavor is to solve the underlying challenges of lack of awareness and proper infrastructure in ETF and create a platform for smooth and inclusive growth of ETF in the country, which is just progressing at this point in time. It's a pleasure to welcome you all on an engaging session on passive investing. This is a webinar being presented by ETF Junction's, ETF Pathshaala, a wing from ETF Junction. Would like to share that ETF Pathshaala is a forum for sharing valuable insight on ETFs and passive investing from different industry experts and eminent speakers from the field. This is being conducted on a regular basis, which is on every month, and is adding a lot of value, I presume. That's why we are seeing a fair amount of traction coming. Coming directly to the today's topic, if you look at, we look forward to understand the name of the topic today is Debunking Myths on Passive Investing. I think passive investing is something which we are getting to hear, ETF we are getting to hear time and again on recent times. We look forward to understand the world of passive investing and how it can make an impact in an overall portfolio of any investor. And if you look at, I think in the dynamic landscape of Indian investing, the active strategies have had an unprecedented growth, right? When I say unprecedented, means from 2001 to 2024, almost 52 times growth, from 1 lakh crore to 52.78 lakh crore. That's an amazing number, right? That's one. But we are seeing the corner turning for the newer pasture, which is the passive investing. Without much further ado, let me first introduce the eminent speaker which we have today for today's webinar. We have Mr. Niranjan Avasthi. Uh, he's the head of product and marketing at Edelweiss AMC. Just to give you a brief about Niranjan, who has been like a pillar in the passive industry as far as mutual fund industry in India is concerned, has got 15 year plus of experience and a cost and management accountant from ICI plus Master Commerce, Master of Commerce and PGDM from Pune University. He was a rank holder there, and right now he's heading the entire initiative of product and marketing at Edelweiss. He joined Edelweiss in 2017. And he's responsible there for the entire product range and the marketing strategy of AMC. Just to share, I think Niranjan has been an integral part of the industry. He was earlier with ICICI Prudential Mutual Fund for 6 years. He's also worked with Reliance, which is now Nippon Asset Management, ICICI Security, Share Khan. So look forward to gaining a great perspective from Niranjan. Thank you for joining.
Thanks, pleasure.
The next we have is Dilshad Bilmoria. She's the managing director at Dilsar Consultants Private Limited. If you see, Dilshad has been over 22 years of experience in the financial advisory itself, which is a huge addition. She manages close to 345 families, which have created financial peace and independence in their lives and help them really reach their financial goals. One of the very strong, I would say, pillar again in the entire RIA fraternities has been pretty active. Her achievement includes writing a book in 22 about the widest owl, right? So that's something which is featured among the really on the prominent seller list. She was also part of the top 100 women in finance leading category for Association of International Wealth Management in 2020. On the achievement side, something very remarkable is 2019 she got the CNBC TV 18 award as the best independent financial advisor women. Again in 2018 she received the similar award. So that's something a great repute. These awards really holds a huge just like Filmfare Awards as far as the investing in India goes, investment advisory in India goes. Dilshad is the founder executive committee member of the Council of Financial Planner, an association to help foster financial advice services industry for the industry growth. Also, she enjoy running. I think she's joined a couple of marathons, some 7 marathon she has been a part of. She's also been prominently featured in the financial, publications in India, which is Outlook Money, Money Control, Mint. Looking forward to get a lot of, again, insight from Dilshad. Thank you for joining.
Thank you for having me on the show. Thank you.
The third speaker, which you guys have been hearing, and when a wealth of experience he brings in. As Koel goes, he's currently heading the strategy initiative at ETF Junction, India's first dedicated platform for local and global ETF aimed at encouraging ETFs in every investor's portfolio. In a previous roles, he has led the regional and commercial efforts at SP Dow Jones as the head of Southeast Asia. She was the CEO of the joint venture between BSE and S&P Dow Indices. Very strong advocate of passives. I think one of the few who's been there around for fairly long, right? And pushing for passives. Now we are seeing things moving, needle really moving in the right direction, but it has been really days when the passives were not even heard of. She's been again an integral part of the industry, has worked at Thomson Reuters, UTI AMC's, IFS management. She's a chartered accountant by profession, and she was recognized by AIWMI as one of the top 100 women in 2019 in finance. So this is just to have that, we have a galaxy of speakers. We look forward to really gain immensely from their valuable insight and, use as far as our entire investing goes. Before I start the questions, I think first from Koel, just to give you a sense that India largely had a very good saving habits, which is one of the top quartile in the global arena. And the good thing which we are seeing is that there is a good shift happening from physical to financial savings, financial investing. Now, earlier, largely, if you look at Indians, they were investing in real estate, gold to a great extent, but now things have really been changing. And to give you a sense, what kind of shift has been, if you look at 5 year back, it was around 45%, right, which was financial, and 55 was physical of the total 100% invested. Now it's almost the reverse. That's a very good news. And people have really seen the advantage of investing in financial instruments, right, from the physical ones, and it is really adding up. And if, as I speak, the total bank fixed deposit, right, and mutual fund percentage. When I say bank fixed deposit, means the percentage which mutual fund investment as of now has vis-a-vis bank deposit was hardly 11.4% 5 year back. Today it stands at 24.2%. That's a staggering shift which we are seeing, and these are very early days, right? And this is just one bit of it, right? If you look at passives, clearly similar shift are or has been seen globally, and we are seeing something similar in India. So the question to you is that, share your perspective for our, investors who have just logged in, what is active and passive very briefly. And then the myth generally people has that, the passive investing is only for investors seeking, average market return. And generally they understand, Nifty Bs, which is relatively more popular, has got really good volume every day, has got decent assets. Now, how do you dispel this myth and highlight the instances where passive strategies have outperformed active or maybe an integral part along with active for any portfolio? Koel.
Yeah, thanks, Saket. And very nice to be again a part of ETF Pathshaala. So let's, talking about, let's understand active and passive to just begin the, kind of conversation here. And always there has been a debate between active and passive, though I personally am a hardcore advocate of passive. The very reason I am kind of now consulting with, ETF Junction right now. So one of the things which I, want to kind of clarify is, one needs to not say it is an active or a passive, choice. Today, a portfolio, like you say, don't put all your eggs in one basket. You don't need to put all your strategies in one strategy. If I have to explain what active is and passive is very briefly, active is when the fund managers select based on their expertise the stocks and put them into the investment portfolio based on what their investment objective is. Obviously, there are costs associated with that research, with the team, with making those choices. And passive, on the other hand, is as simple as just replicating an index. Saket just mentioned Nifty, Sensex. You take the 30 basket and you take the 50 basket and you just replicate it. So you can buy a Nifty basket with as small as 500 rupees. So it's that simple. There are cost benefits, there are liquidity benefits, and there is an absolute transparency when it comes to passive because you can see what's happening on a day-to-day basis. Sensex, second by second, you can see it on the website. There may be a little lag in terms of what the website is showing, but more or less you know that Sensex and Nifty are kind of your country indicators. So that kind of brings that, aspect into it. So like you said, there are positives and negatives on both sides. Active has the fund manager expertise, but one must know that and have that sense of financial awareness to know, okay, this is the kind of fund manager and this is the kind of experience and this is the kind of historical performance that this fund has given, because nobody knows the future, right? The market keeps changing and there are risks associated. So whenever we are talking about investing, there are risks associated. There's risk in anything we do, but obviously what a passive does is it offers diversification. So you are again kind of creating a spread across the sectors, the stocks, etc., that you're putting with that passive approach. Now, coming to your other side of the question, Saket, saying that the people associate passive with market returns. It depends on the product. There are different kind of passive products. You have market return oriented products. You have products which are called today as smart beta products, which is what is smart about it. Beta is usually associated with a word which is kind of synonymous to market returns. So smart beta is when you are using a lot of the factors and the rules and regulations that active fund managers use to select stocks, formalizing it and creating an index out of it, so which it gives you a differential return to market. So you may use fundamental factors like PE ratio, book to sales, a lot of other profitability ratios, and create an index. So that's the thing. Now, just to maybe debunk the myth that active is better than passive, and I know Niranjan comes from both sides, so Niranjan, you will probably have a different thing. But of course, there are certain segments that passive is doing. One of the segment that passive is doing very well, and I must show, because I'm like an ex S&P person. So if you can see the screen that I'm displaying, this is a SPIVA report. So SPIVA report is nothing but where you are comparing, which the active funds versus the passive side. Now, this is a report as of June 30th. You can actually go to this website of S&P and, kind of see this. This is a report that they've been doing for the last 10 years. So there's a 10-year record that shows that this is the kind of, the bar shows the percentage of active funds that are underperforming. So if you see in the Indian large cap space, most of the bars cross 50%. So obviously that's the space that is really, maybe the passive is a better, strategy that one can use. There are other areas like in the mid cap, small cap, where there are spells in the, year to date in say, 3 years in a long term that mid caps may have done better. But even if you see in the bond funds, you see in the debt category where you may be surprised, the actual passives have done better than the active. And I'm sure Niranjan has more to share on that. So this is something that I really wanted to, showcase, that this is the reason why one has to look at passive when you are looking at an overall strategy. Over to you, sir.
Thank you, Koil. I think quite a good perspective, especially for the people who are there on the call to understand and differentiate between active and passive. Very well explained. Coming to the next question, before I just speak, let Niranjan take it over. India has seen an 8 crore investor in equity, right? Approximately from 13 crore demat account. That's a staggering growth, almost around, if you look at the growth which we are seeing, we are adding on roughly around 20 to 22 lakhs SIP every month in mutual fund, roughly around 25 lakhs demat every month. And given the trend, right, by most conservative estimate, we'll be able to add roughly around 8 crore more by 2027. That's just a couple of years, right? And approximately, 30,000 crores of inflow. Mutual fund itself is $2.5 billion, right? And if you look at total, approximately 4 billion every month is coming in, right? If this trend continues, we'll be getting 100 billion from the domestic market, right, every year in a couple of years. Now, that's the kind of staggering growth which we are going to see. And obviously a larger part, right, has come, in active. Maybe it would make some way for the passives, right? So Niranjan, the question to you, right, which is that, when there's a lot of new customer comes in, they have a question that, there is a belief that the passive investing is only suitable for certain type of investors, right? Such as those with a short-term in horizon traders, right, and all. How do you debunk this myth and highlight the veracity of passive, right, strategies for in every segment of investors? Niranjan.
Thanks for having me, and great to be here. To start with, passive investing, there's a lot of focus on low cost, whether it generates alpha or doesn't generate alpha. But one of the most important benefit is not often talked about is when you select an active fund, right? Uh, it's a long process. You say if you're investing for 10 years, you'll have to see for all these 10 years, this active fund is beating the benchmark. The fund manager strategy is according to your objective, how the portfolio is changing. Most importantly, in this 10 years, there will be years when this active fund will be underperforming its peers and benchmark. There'll be years when it is outperforming. It's quite difficult for someone to keep reviewing this portfolio and staying through the entire course. The behavioral impact on such is a lot of people exit these funds when they are underperform and get into funds which are outperforming, and which is a cycle. It's a vicious cycle because you tend to get out of fund which may outperform in next 1 or 2 years, and you're getting into a fund which has already outperformed and maybe underperform in next 1 or 2 years. And we have seen this behavior across active funds. In passive, the biggest benefit if you're investing for long term is you don't need to review this. You are getting market returns and you just stay the course. The behavior gets so in a way it is it tries to make your or correct your behavior in a much better way. And that is where I think so passives are more suitable, at least in my mind, for long-term investors than short-term, because taking a call on a fund in a short term is quite easy, but you don't know in a particular active fund next 10 years what's going to happen. And we have seen many active funds doing very well in a certain period of time, and over the next 5 years or 10 years they are bottom of the quartile. And of course they will come back at some point in time, but most investors exit at the wrong time and enter at the wrong time. So passive actually, because of this very reason, is a long-term investing form because it gives you peace of mind, which is most important. And with peace of mind, it corrects your behavioral mistakes that you tend to do with active investing. The other thing is you spoke about short term. Yes, it is good for short term investors also, uh, because you can take a call on market beta. You can take worries, all those things are there. But ideally, it is good for any investors. So forget about short term and long term. Is it good for an investor who is creating a portfolio of different styles? Of course, yes. As Koil was mentioning, there are various strategies within passive, and I'm sure we'll talk more about it as we progress in the webinar today. But actually, at least in India, as we have started, yet we have huge array of products which suits number of investors. We have debt passives, we have equity passives, we have smart beta, and I'm sure in coming years we may have hybrid, balance, other passive funds as well. So actually it suits each and every investor.
Thank you. Thank you. I think that's pretty important and interesting point you made is that do not keep reinventing the trend or maybe the strategy of investing. Just stay the course. Thank you. Thank you so much. Now, coming to the third question, and clearly, this is something coming from someone who has been at the hallmark of advising, right? If you look at the three pillars of really, any good portfolio, safety, liquidity, and return, and it's the right mix which gives you that kind of output, right? So just one question, being asked from Dilsad ma'am, that many investors believe that the active managed fund obviously outperform the passive ones, right, over a long term. How do you address this perception? This is a very strong, I think, embedded perception, especially in the recent market trend which we are seeing, right? Obviously, because there has been a lot of mid small cap movement happening, a huge amount of collections happening that side. So this one common myth is the passive investing lack flexibility. This is the second point. Third, how does the ETF provide investors with the flexibility in their investment strategy compared to the traditional mutual fund, which they've been investing large in number?
Yeah.
Dilsad.
Right. So I think the bottom line, and when we build portfolios, it comprises of both passive and active and core and satellite, right? So that's typically how an advisor would build the asset allocation kind of pyramid. So I think the main point in discussion is the expense ratio and therefore the return to the investor, right? So typically active is what we suggest, where we would find if the attribution analysis or the contribution done by the fund manager is able to give better returns than in a mutual fund compared to an ETF. Yes, we would definitely suggest an actively managed fund. But ETFs also have their advantages, especially when it comes to passive investing. And there are certain costs, like for example, the 12B1 costs, which are not prevalent in ETFs, which are there in mutual funds, which are the sales and marketing costs. Or, for example, it could even be the exit loads, which are there in mutual funds. Again, so the good thing about ETFs is, of course, it's liquid. You buy them at current prices, you get the liquidity, you get the market price as and when you're trading. There are INAVs which also provide the underlying portfolios, closing overall portfolio value at the end of the day. So I think we can't always say that passive ETFs or passive funds will outperform active, because these change depending on so many factors. It could include both the macro factors as well as the fund manager's contribution to the overall performance. So I think this is where you will, and I think Niranjan brought this out also, this is where you will need a financial advisor to actually help select that basket of investments, because the performance keeps changing, right? So today's best performer is not going to be even 1 month, kind of an outperformer. And I think that is where you will need the guidance of a financial advisor to help you select a kind of asset allocation, and also look at both the passive and active strategies that are available to meet the requirements of the investor.
Thank you, ma'am. Thank you so much. Very rightly said that it's not only the asset which rotates in the return, but also, the performance of different funds rotate, right? The winners keep rotating. And that's where a good financial advisor from your side who can, have a combination of active and passive put together to give a better, mileage in the overall portfolio. Coming to you, Koel, I think you just shared, the SPIVA report, which gives you that roughly 50 to 90%, cases where from, mid to large or even ELSS, the benchmark has not been beaten. Just to add to what you shared is that if you look at the best we have in the world, in the planet, as far as investing is concerned, is Warren Buffett. Warren Buffett and, I think the person who recently died, Charlie Munger, both roughly did some 300 stock research, because they were very, very, sure. They didn't really pick up the ideas every day. So they're in their entire investing, career so far, it was 300 stock they researched. Out of that, 100 was brought into the portfolio so far. That's how selective they have been. There are times for 2.5 years, for 5 years, they have located one stock. And of this 100, you'd be surprised that only 12 stock has given 50 to 100%, 100 times return. That's the multi-baggers. Couple of them, and the name, if you look at, is Coca-Cola or maybe, American Express, to name a couple of them. So just 4%, 12 out of 300 is just 4% coming from someone which the entire planet has produced the best amongst us. That's global. Come to the domestic. I think Rakesh Jhunjhunwala, I think is past, is someone who really started early, taking 10,000 from his father, and also there was a lady from whom he borrowed 25,000 rupees and all that. I think if you look at today's, his holding is worth roughly around 85,000 crore. It was two stock largely, which is 25 to 50% of the portfolio at respective point in time, was Titan and Lupin. That is how skewed, that is how the entire dice is loaded against the multi-baggers, which is the real fancy. On the contrary, if you look at, Dow Jones has been posting close to 9% in the last 100 years. Look at our Indian indices, which is Sensex, has posted roughly around 13.7 to 14% ex dividend. If you add dividend, roughly around 15%. So this is where, you have a, I think Niranjan also shared, there's a fair bit of visibility, right? You are relatively much more surer than 4% chances of you creating that multi-bagger where everyone is looking to get the alpha. So the question to you, how do you see, the entire things traction changing globally for, passive investing, which is really, really pretty strong, and domestically, where do you see things? Go ahead.
Yeah. So, the fact of life is the global markets and the developed markets are far ahead, in the game than we are. But India plays a lovely catch-up, speed-up game. So today, if we look at the global markets, it's more than $11 trillion. And with more than 10,000 products, variety of it, they are just not, market beta based, but you have smart beta, you have now of late, Bitcoin has made the recent entries with almost, BlackRock and the main big guys have introduced Bitcoin in. Obviously, it's a while away since Bitcoin can get approvals probably into our markets. But I think what the trends that have, if you have to see, a large part of the assets today of those 11 trillion are based in the US. You have a speedy growth that's happening in the Europe space. Japan and Australia are also gaining ground where it comes to regional growth in the passive space. If you have to look at the asset size mix, equity always is kind of the lead on the leaderboard. But what has been showing really quick growth is the fixed income space. So that's another place that's really picking up where it comes to passives. So that is something that one really probably needs to look out. I don't know how far Bitcoin will go in its speed, but it's made its first few steps forward. So that's more of a global space now. A lot of the factor-based products today that India is seeing is something that globally it's already been established. It has got certain good amount of assets under management there. ESG for a long time, a few years back, had that kind of growth in assets. It's making its changes. One of the things before I come to India, which is also making its move in the global space and moving the passive needle, are active ETFs. So I think a lot of mutual funds are realizing in the global space that the low cost model is much more, and the mutual funds are converting themselves into active ETFs. So that is another new space that is coming up. Maybe India will jump right up to it, but as of today, India's passive percentage among the entire asset management space it's around 17% of the total assets, right? Around 8.5 lakh crores is what the assets. It's almost like a 50% growth in the last couple of years, right? So, I mean, and the maximum number of growth, surprisingly, has been during the COVID time. So I think when people were at homes, sitting down, getting their learnings, there was a lot of learning that came through an understanding of the passive. Here we are talking about, demystifying myths, etc. A lot of people, kind of think that passive is meant, it's too complicated and it's meant for something where your earnings are also passive, but that's not true. If for a lot of people who are new investors and who have never experienced the market and are scared, probably, I don't know the markets very well. You don't need to know the market, you don't need to know all the stocks. You invest in a simple product like an ETF. It gives you exposure to sectors, it gives you exposure to stocks, and you don't need to be a financial or a mathematical wizard to understand it. The biggest fear that I hear when I'm talking to a lot of investors is, and these are people who are in very kind of big positions in organizations, or running their own business, or having very professional, running successful professions. And I'm sure Dilshad meets a lot of them where they say, we don't understand. Of course, one of the things is we have Dilshad amongst us, and I'm a big propagator of financial advisors, because I think everybody can't do everything. If I'm a doctor, my profession says I need to be good at fixing people. If I'm an engineer, I should be fixing. If it's creating motor cars, I should be creating motor cars. So I should give it to an expert, somebody like a financial advisor like Dilshad, who then looks at the entire expanse of what my journey and what my financial goal is, right? And that's the way. I also, in fact, recently was at a book club where it was talking about financial planning. And I realized, I've always taken care of my own finances. And I realized that, unknowingly, I have always known that, okay, if I have to take care of my assets, and I have to build my assets in a home, if I have to get a car, take care of medical expenses, there's a whole thing, take care of children education. You have to keep so many things at mind when you're planning a financial goal. So I think that's where it all comes to. Passive allows you a very easy ticket to get those, market-based returns or differential returns through smart beta products or through any other kind of products, which you can then get in and aim your and get your financial goal completed.
Thank you, Koel. So the guiding word is passive provides you easy ticket. Clearly, something which is a larger part of the country, roughly around 4.1 crore, 4 crore people who are investing in mutual fund. Lot many are yet to add, and this is the first instrument they should really experiment or start investing with. Thank you, Koel. Coming to the next question, I think if you look at passive, and thank you, the gentlemen and ladies, really helping the entire myths which is prevalent in passives and helping the investors who have logged in for them to understand. And also when it get repurposed at YouTube, there's a huge following there which will really quell this all misconception on the norms which people have been knowing over the so many years, right? Coming to Niranjan, the next question is, there's a misconception that passive investing means sacrificing return, right? Though you covered a little bit in early, could you explain how passive investing can actually offer a competitive return, especially in certain market conditions where it get highlighted strongly? Niranjan.
Right. In investing, you can't get everything. Let's be very honest. If you are investing in active, whether it is passive or any asset class, आपको सब कुछ नहीं मिलेगा, and you have to sacrifice some or the other thing. Like in active investing, if you are gaining to get alpha, you'll have to sacrifice some bit of peace of mind, some bit of your, because there will be cycles. If you're investing in a plain Nifty 50, you know that a passive fund will not beat Nifty 50 because it is not designed for that. But that's what you sacrifice, maybe 10, 20, 30 basis point you sacrifice, and but what you get is peace of mind. It's a fill it, shut it, forget it kind of product. That said, this myth that passive means sacrificing return isn't true, because there are different funds within passives, and we talked about smart beta and all. So if you are what index, so because returns are always relative, right? If you are looking a market cap based index and buy an ETF or an index fund based on that, you may be sacrificing few basis points here and there compared to the index. But if your objective is to earn a return better than maybe Nifty 50 or maybe better than mid cap 150, which is again a broad based market cap, mid cap oriented index, there are smart beta products. Like for instance, momentum factor for the last 3 years, 5 years, 10 years have generated an alpha of almost 5 to 7% in India. That's over and above a market cap based index. So definitely passive doesn't mean sacrificing returns. You have to select the right asset class and also keep your expectations right from that asset class or the strategy. For instance, in the large cap space, I talked about mid cap. In large cap space, if you see last 1 to 3 years, quality as a factor has outperformed Nifty 50. So there is a quality index which has outperformed. There are times when a low volatile factor would outperform a market cap. So it is definitely, more nuanced as you understand about passive investing. Maybe a Nifty 50 or maybe a BSE Sensex ETF or index fund is a dal chawal. That is the core. I mean, you start with that. But, over a period of time, as a child, you like dal chawal, right? As you grow, then you start eating different vegetables, chapati, biryanis and all. So passive investing is also that. You start with basic, and then as you understand the nuances, then go to next level. Then adds maybe smart beta, then add sectoral. As a portfolio, I'm totally convinced that if you have good knowledge about passives, you can create a very good portfolio. And as Dilshad also mentioned, in India, honestly, the time is not whether passive is good or active is good. It is, first let's start investing. So if you are a DIY, definitely passive is the first choice for you. If you're not a DIY and you have an advisor along with you, like Dilshad and many others, wonderful MFDs and advisors that we have, definitely you can have a portfolio mix of active plus passive.
Thank you, Niranjan.
So that's broadly.
Thank you so much. Well said. Passive is not just dal chawal, but it has got, the taste of dosa, taste of biryani, taste of burger, whatever taste you look forward to, there are themes which are there. And he rightly said, we have smart beta. There are a lot of other themes which, as per your taste and suitability of your portfolio, you can look at. Coming to the next question, Dilsa, the fact that, we are lured to ask this question because you have been at the forefront of advising, had seen so much of, decades of investing advisory which you have done, and it really help a lot to all the people, all the listener, right, to understand the perspective here. So there's a misconception that passive investing is a set it and forget it approach, right? And also that ETFs are so simple, I can just do it, right? That's something, people generally have. How do you encourage investors to stay engaged with their passive investment strategies, right, over the years and make informed decisions despite the hands-off nature of these investments? Dilsad.
Right. So I think like Koel and Niranjan both mentioned, for a first-time investor who really doesn't know, where to invest and what to do, I think broadly what we also would recommend for a broad asset allocation is like take one equity ETF of say a Nifty and take a debt one, which would more or less balance the portfolio. But as the investors' wealth accumulates and grows over the years, and as we come across their kind of different needs, like so Koel mentioned, like it could be education, or it could be a retirement, so each of these passives also require adjustments in the portfolio. They also require whether how much equity, how much debt should be there, how much commodities should be there, how much cash should be there, how much and all this is available in passives, in ETFs, in actives, right? So I think the decision also comes around points of where does what are my objectives, what are my goals, how close am I to achieving a particular goal, and therefore should I start moving into safer kind of strategies to protect the wealth that is already created, right? So I think those are the important decisions.
Hello.
On passive, but definitely for a first time that will add to the alpha. Are you able to hear me?
Yeah, go ahead. There was
Yeah.
some interruption in between. Please go ahead. Yeah.
Okay. So things like the momentum or the factor or the quality or the low volatility. So what we do in fact is we try and include, if it's a factor based, we try and include all four factors, right? So quality, momentum, growth, and value. Now, why we do that is because markets in different market cycles behave differently. So when we are suggesting a factor-based strategy in, say, a passive, we would like the investor to benefit from all, because a market cycle can go either towards cyclical investing or it could go towards value investing. As we see the markets change.
Yeah.
So that's where you would actually need the hand holding to say when do you put in these factors, when do you move out, so that is why you need even in a passive ETF, you need the guidance to take calls on that asset allocation changes.
Great, thank you. Just to compelled to ask this, how frequently do you revisit the portfolios in general?
So we look at obviously strategic and tactical asset allocation, predominantly strategic. But so when it comes to say events like the budget or the election, etc., so that's when you need to take tactical calls or profit booking, etc. So I wouldn't give a number. So ideally we do it at least once a year in terms of rebalancing. If not, it should be at least twice a year. But again, there is no rule to it, right? So these are based on internal triggers that we set, and then it goes out to the clients through the planners saying that why are we suggesting these changes on rebalancing, etc. So it all depends on both the micro and macro factors as well.
Thank you so much. The next question is from Niranjan, and there's one perception which generally the country and passive investing in the country has been really looking at bothered is the liquidity part, right? Though we have seen a fair amount of catch up happening with the authorized participants and many more adding up there, and also when we look at a lot of big ticket liquid fund, being bought without serious impact cost being there. So Niranjan, just to understand from your side on the liquidity, liquidity concern often arise with the passive investment generally, right? And if you especially look at when the market is on a downturn, when there is a concern on the liquidity availability, how do ETFs and other passive vehicles maintain liquidity first, and what measures can investor take to ensure that the liquidity in the passive portfolio is better placed? Niranjan.
Right. So, liquidity, of course, is one important factor when you are looking to invest in an ETF, because a low liquidity is actually an additional cost for you to invest in these ETFs. In India, if you see, and how does liquidity come? Liquidity comes from two factors. One is how well the market maker ecosystem is, and second is how big is your investor base. Now, today, if you see, our investor base in ETFs has crossed, roughly 1.2, 1.3 crore folios, or rather number of investors, which is, very good for overall liquidity. At the same time, what's happening on the market maker ecosystem?
Hello. Niranjan, can't hear you. Hello. By the time I think we missed, I think lost Niranjan. Can I have this next question, which is from Dilsad ma'am, is that finally there is a belief that the passive investing lacks innovation, right? And generally people really look forward to the dynamic change happening in the world, and especially today when there's electric cars, or artificial intelligence and all that, right? So the question too is finally that there is a belief that the passive investing lack innovation and ability to capitalize on emerging trends. How do passive strategies evolve to incorporate new market development and technological advancement, and how can investors stay informed about these opportunities?
So not at all, actually. Passive, the strategies that are sometimes available through ETFs are not available in the regular mutual fund options, right? So, for example, a smart beta, when we inquired about it, one of the fund houses told us that it's only available through an ETF strategy. So, I think at the end of the day, what is that strategy is what matters, whether it comes through ETF or whether it comes through a mutual fund. So I think because of certain restrictions, in fact, on by SEBI on the mutual fund categorization and the allocation. So, for example, a flexi cap mutual fund will have restrictions on how much can be in large, mid, and small. Similarly, a multi-cap will have restrictions on how much can be because of the SEBI categorization. But those kind of restrictions are not there in ETFs, right? So that is what makes the game or the investment strategy interesting. So I think definitely ETFs have very interesting strategies. For a very long time, we were doing low volatility and it was not there in mutual funds. It was only there in ETFs. So those kind of things are, and I think that is picking up. So people are realizing that sometimes when you need to add investment options to your portfolio, if it's not available in the more traditional form, like through mutual funds, then you would go with, the ETF option. So again, it all boils down to what strategy that you are building, what is that asset allocation, and then look at, which kind of vehicle works best. Would it be the mutual fund? Would it be the ETFs, etc.?
Thank you. Just to add to that, I think today globally some 11,000 ETFs are present, which is varying from one ETF. There are AMC dedicated, and when I said 11,000 ETFs, this is coming from 554 approximately manufactured across the globe. Right, so that is where the diversity is huge. There are water ETF, one stock. I think recently Tesla crossed $1 billion, one stock, where people have been investing, right, with leverage of 3 times, 5 times. Clearly, there's a huge innovation. Thank you so much. And Niranjan, we missed you. Can you please continue on the liquidity we were discussing?
Sure. Yeah. So I was just talking about one regulation which SEBI has brought in last year, which now restricts investors to go directly and create units through AMC only after 25 crores. So anything which is below 25 crores, if you want to invest, that has to come to exchange. Initially, what was happening is, even 1 crore, if you wanted to invest, you had an option to go to AMC and create those units. So that liquidity was not coming on the market or on the exchange. Now with this, a lot of people are coming on the exchange. For market maker also, there is huge volume to support. And this is one very important decision. In fact, when we started Bharat Bond ETF, we were told that who will buy it. We had bought in this restriction where anything below 25 crore had to come to exchange. From the very first month, we had seen, we had launched two ETFs, 2023 Bharat Bond and 2030. We had seen a volume of 5 crore. 5 crore in debt market is huge. So with this kind of regulatory ecosystem, market makers coming in, I think so liquidity today is not such an issue. If you ask me, can it improve from here? Definitely. But there are, large size ETF, very liquid enough for anyone to buy even 50 crores or 100 crores today. One thing investor needs to see is, when you are going to buy an ETF, how is the variation from the INAV, and how is the depth of the bid and ask orders, and that way I think so it's quite easy for retail investors. If you ask me, buying 1 lakh 2 lakh on a daily basis, I don't think liquidity is a much of an issue today as far as ETFs are concerned.
Thank you. Definitely, I think, and as we progress, I think more and more participation coming in, more and more units being bought, liquidity will further enhance immensely. Just one question again from you, Niranjan, since you spoke about Bharat Bond ETF, right, which has really had a good understanding and good, I think, good pick initially before this tax came in between. Where are we placed on the hybrid and what's happening? Any idea there?
Okay, so it is largely the so I'm part of the ETF committee as well, and SEBI is looking into this. I don't think so. It will take too long, but definitely we may see some hybrid passive funds as well coming in for the investors.
Okay. Thank you so much. I think these were primary questions. I think we have almost reached the time. Any question from audience, please feel free if you can put it on the chat so that the panelists can answer in case if anyone intends to ask any question. Or anything anyone of you would like to add further in case the question is not coming. Koel, Dilsad, Niranjan, anything you'd want to add further to the entire discussion which we're having on quelling the myths of passive investing?
I think so, to some extent, we are, quite obsessed with the cost in ETFs and this thing. I think so a lot of investor needs to see the other side of passives also, like peace of mind, fill it, shut it, forget it kind of nature of these passive funds. Also look beyond just, market cap based indices, which is, our top 100 or top 50 stocks. Many AMCs, including us, have many interesting smart beta ETFs. But yes, first understand what are the nuances of it, but do explore because it will add a very different style diversification. Because in India today, we have been talking about asset class diversification. We have been talking about, sectoral diversification. Time is right for also style diversification. So most mutual funds are largely focused on growth style. I think so. Momentum, value, quality is also some other factors which investors should start looking at.
Thank you.
Yeah.
Koel, your closing remark?
Yeah, and I think the important thing is to start. I think most of us are kind of maybe hesitant, sometimes fearful, sometimes kind of apprehensive that we can't do it, let somebody else do it. But I think the main key is to just start beginning. I mean, in today's world, we go out and eat and we spend around, maybe it's a minimum 1,500 rupees that you would spend if you're going out with friends and include all the specialities that you're going to have. So, if you can take that and make it a disciplined approach towards investing, there's nothing, that can be, you'll probably thank me later on saying that, I heard her saying, let's begin. Let's put that one, outing that I have, that budget into a monthly, say, SIP, right? And put it that. Now I said, like, a passive is, of course, my passion. So I will definitely say put it in a passive product. But like I said, Dilshad mentioned, it is more about, how and where you want to place the money and what are the options available. Sometimes what you are searching for is not available, maybe in the active piece, maybe is available in the passive piece. And especially, there is such a lot of, since we are demystifying all the myths, there's such a fear that, I can't handle finance. That's a complete, it's a no-brainer. Everybody can do finance. I've been talking on a lot of forums where I've been addressing women, and I've noticed that there's a fear among them to come into the front and start investing. But these women are efficiently managing their homes. Why can't they manage, their own budgets? And then there are others who are also have their own incomes, doing so well for themselves, very successful in their careers, but so fearful of, the word finance or investing. I think it's just once they get into it, they realize how simple it is. On the contrary, there are a lot of women out there who may be on sabbaticals, etc., taking care of their children, but at home they are actively using their skills to, create portfolios for their families, for their investments. So it's just, the key word is just begin.
Thank you. Thank you, Koel. Dilshad, your closing remark?
So just to add to what Koel said, I think the right savings ratio is between 35 to 45%, right? So pay yourself first by investing and then expend the money or spend it, right? So don't want to put a blanket statement, but typically the youngsters are always about spending and credit, and that's what is the thing going on. But I think they will see the benefits of this once they just see how compounding works, right? It's such a simple word and such a simple concept, but actually compounding really works very well. So I think first pay yourself by investing and then go about spending.
That's beautifully put in. First pay yourself and then go about other part of things. So that brings us to the end of this session. Thank you so much. A heartfelt thank to all our esteemed panelists, right, for sharing their wealth of experience and knowledge to all the participants. As we conclude, remember, in dynamic world of investing, it's all about I think choosing all flavors of investing, just not active or a combination of the two, active and passive, and what best could be there as advised by the advisor in your portfolio. It's all about creating a good harmony and right kind of synergy of strategies that resonates with your financial goals, right? So thank you so much, all three of you, Dilshad, Niranjan, Koel, for a very valuable insight. Thanks a lot. Thank you so much.
Thank you. Thank you for having me.
Thank you.